Hey, it's Mike Hambright with FlipNerd.com. Welcome back for another exciting VIP interview where I interview some of the most successful real estate investing experts and entrepreneurs in our industry to help you learn and grow. Today, I'm joined by Matt Aitchison, who is a California real estate investor, CEO of Vault Investment Properties. He actually has several businesses, one of which is a construction company, which has enabled him to create new opportunities by adding on square footage to houses that he buys. So it's an interesting strategy to create value in your deals, maybe allow you to do deals that you couldn't do otherwise, especially if you're in a higher priced market. So it's not a topic that we've talked about before, but it's something that's very interesting. Looking forward to diving in here with Matt. Before we get started though, let's take a moment to recognize our featured sponsors. RealtyMogul.com is an online marketplace for real estate investing, connecting borrowers and capital from accredited and institutional investors. Get a rehab loan fast and close in as little as 10 days. Rates start as low as 9%. We'd also like to thank National Real Estate Insurance Group, the nation's leading provider of insurance to the residential real estate investor market. From individual properties to large-scale investors, National Real Estate Insurance Group is ready to serve you. Please note, the views and opinions expressed by the individuals in this program do not necessarily reflect those of FlipNerd.com or any of its partners, advertisers, or affiliates. Please consult professionals before making any investment or tax decisions, as real estate investing can be risky. Hey, Matt, welcome to the show.
Hey, how you doing?
Good. Hey, thanks for being on here. Before we get started talking about the topic today, first I want to say congratulations on the new baby. I know you're a new dad.
I appreciate it, man. Yeah, I'm surprised I even got my eyes open right now.
Yeah, I remember those. My son is 7 now, but I definitely remember those days of, both my wife and I have. We each have 2 siblings, so there were 3 of us, and we're like, how did they do more than one? Like, one is hard. So
we were literally saying the same thing. We want more than one, and we were talking about it. We're like, we might need to revisit that idea in a few years.
Yeah.
I don't know how I could have a 2-year-old and a newborn at the same time. That just hasn't registered with me yet. But no, I appreciate it. We're extremely blessed and excited, and never had a better reason to be more exhausted. So it's great.
Yeah, that's awesome. Well, so and what's exciting to talk about some of the topics today is that you're a young guy. I think you're 26. Is that right?
That's right.
Yeah, so you've done a bunch of deals, you have a bunch of businesses that are thriving, which is fantastic. Why don't you tell us a little bit about yourself and kind of how you got into real estate investing?
Sure. Yeah. So 26. I got into real estate investing. Let me back up a little bit for you. So I was 14 when I went to my first flipping seminar before HGTV had a million shows on it. And my mom was actually taking me to these. My mom, a successful businesswoman who kind of worked her way up to corporate America, and she was looking for other ways to increase, passive income or income buckets, I guess you could say. Yeah. And so she was taking me to some of these flipping seminars, paying $5,000-$10,000 per weekend or week or whatever it may be. And
you were the free guest.
Yeah, I was, man. I was the lucky guest. And as most people do when going to those seminars, they pay all the money, they buy all the extra add-ons, get all the content they need to go out and be successful. And they get home, they lose the energy, they put it right back on the shelf, and they go back to their day job and their comfort zone. Yeah. And so as she was doing that, at 14, 15, 16 and on, I was going into her office and I was reading all the content. So I had that early, I guess, entrepreneurial bug of, man, real estate investing could be a great opportunity with no ceiling on what I can achieve in it. And I went off to college at UC Santa Barbara. I worked at an investment firm down there and started getting more acquainted with numbers. And I fast forward, I graduated, came back to the Sacramento region where I started my first real estate team with my partner, Rachel Adams, and we started building a team, and I started my career out with one flipper, and I started seeing a lot of the deals that he was picking up, and I was doing the project management, I was doing the listing side of it, the marketing side of it, and I started seeing how much he was making on those those net sheets, and I said, all right, I can do this. So I started self-educating myself a little bit more, and that's when my first venture of real estate investing took place when I was 23.
Yeah, that's fantastic. And so talk a little bit about that process of working with somebody, that, because a lot of people have that same experience. They work with somebody, they see how much money they're making. Often I think they see how much money they think they're making, because a lot of times employees don't see the risk side or the bad months or things like that. But just talk about that experience, and if you have any regrets there, because I think there's some people that I know that feel like they regret that. Some people appreciate the experience because it allowed them to move on. Some people think that they should have been making that money when they worked for that person. Or it'd be interesting to kind of hear your experience.
I'm a big believer in personal growth and education, and mind you, when I was in school, I hated it, and I couldn't wait to get out of it. But when it was something that I was passionate about, I really wanted to soak up every aspect of it. So even though it was kind of like that carrot that was constantly being dangled in front of me, and my approach to it was, this is an opportunity for me to learn every single thing that this guy is doing and how he's making this money, and I can go put my own spin on it. Right. And so there was a price tag tacked on to every single opportunity, whether that was a conversation or a contract that I saw, or how he negotiated a specific deal, or how his contractors came in and did this but didn't do that, and really kind of learning the science behind it. Right. Mind you, I wasn't making a ton of money at the time. It was literally no money. I mean, these are smaller price points, discounted listing prices, that kind of stuff. But looking back on it, that was probably the cheapest educational piece I had ever received in my life. Sure. And it's paid me more in dividends over time. So it was a great experience. And I think a lot of people necessarily want that quick fix, that solution to making fast money. And you got to be committed to the process. I've heard that so many times from different people, is just stay committed to the process and learn. And looking back on it, I mean, it's been one of the biggest game changers for me year to date.
That's fantastic. So what's interesting with our topic today is, so I primarily operate in Texas, North Texas. And
is it true that everything's bigger in Texas?
Say that again?
Is it true that everything's bigger in Texas?
Maybe. Yeah.
Maybe.
We love it here. It's great. I'm not from here, but I do love it here. But it's a great investing market, no doubt about it. There's a lot of growth in Texas, a lot of population growth and things. But one of the things that's interesting about here is prices. A lot of times, there's pockets of really nice neighborhoods where this isn't true, but is not too far from the build price. And so it's hard to kind of arbitrage adding square footage and creating value there, which is very different from the coasts, in California, even the East Coast, and a lot of areas where you might be able to add on square footage and create value. When we typically look at houses, we're looking at it as it sits, the square footage that it is, and trying to figure out what the ARV is, and then figuring out how much you can pay on it based on, needing to make a certain amount of profit and how many repairs it needs and things like that. But it's very different when you start to say, well, I can, I know that I can build for a certain price, whatever it might be, $100 a foot, and houses are going for $200 a foot. So I can add on 1,000 square feet and create $100,000 in value. If I did that math right there, I think I did. That definitely creates a lot of new opportunities for real estate investors. So I'm excited to talk about that.
Awesome. Yeah, it's been something that, especially in shifting markets, if you're not in a heavily appreciating market where you buy a deal and by the time you get through the rehab a month or 2 months or however large the project is, 3 months later you gained 3, 5, 6, or however fast your market's moving. Last year in the Sacramento market, I mean, we literally saw a 16% appreciation in a 12-month time frame. So you could buy a deal, not even work on it, and still make some money if you wanted to. Yeah. As the market shifts, though, and getting a little bit more creative on how you keep those spreads and margins to the levels that you as an investor have in your criteria, adding on square footage and that side of the design process becomes a little bit more important, especially if you have the tools and resources to go out and implement and execute on it.
Right.
Not a lot of other people, your competition gets a little bit thinner in those areas as well. So that's something that my team and I have explored in the last year as our market has shifted. And I think it's something that really it can apply in any market if you just know the places to look and you build up the resources around it.
Yeah. And of course you have an advantage by the fact that you have a construction company, so you don't have another middleman there. Yeah.
That helps.
Yeah. So talk a little bit about how you identify. I mean, obviously, let's talk a little bit about why you do it. There's some real estate investors that just don't want to tackle add-on projects and all the additional permits and all the additional things that might come with that. But talk a little bit about, why. Obviously, you do it to create value to make more money, but talk a little bit about specifically why you do it and how you kind of fell into that.
Sure. Yeah. So, ideally we do it because as a 50 flip year shifts into a new market, and you're not necessarily granted the same opportunities that you were, say, in a previous market. You got to get a little bit more creative on how you go about making your hitting your goals and making your projects work. So why we do it is it allows us to operate in a sphere that, like you said, not a lot of investors want to play in that arena.
Yeah.
If you don't have the processes and systems built up around it, it can be very intimidating.
Sure.
And let me be the first to say I've fallen flat on my face and failed a few times, but I learned so many things around how to do it differently the next time and not make those same mistakes. And now it kind of puts you in just playing in a different sandbox that, say, some investors just don't even want to, go build a sandcastle in. So that's one arena where it allows us to kind of separate ourselves from other investors. Obviously, it allows you to create spreads that necessarily wouldn't be there if you were to just do a traditional rehab on that house. Right. And it also the other side that I really like about it is it generates revenue for my construction company. It keeps my guys busy, longer in longer terms, and it allows us to continue to build up new resources and new opportunities around those projects,
Sure.
depending on how long the site. We've pulled other deals just off of the add-on projects that we've done that have turned into additional revenue for the company. So there's a couple different reasons why we do it.
Yeah.
But mainly it initially spawned from, we don't have the same luxuries that we've had in previous, in and out cosmetic type flips. What can we continue to do to keep the level of properties coming through the funnel, but also how can we find ways to increase our margins?
Yeah.
And that was one key way, at least in our market, that allowed us to do that.
Yeah, that's an interesting. We don't have a lot of time to talk about it today, but I definitely had a lot of guests on the show lately where we talk about, and I feel it too. This is a very different market now. It's harder to buy, and when you get deals, some people are either sticking to their principles, and when you get a deal, it's more profitable than in the past, which is great. Some people are have designed their model now around paying more than historically they would, and they're doing thinner deals, and so.
Yep.
Irregardless of what you decide to do, I think it's critical that you always think about how to kind of pivot and shift your business as markets change, because they're going to change. They're all going to change.
That's the one thing that one of my mentors always taught me was the only constant in life is change.
Yeah.
And if you're not willing to adapt, you're just going to either get burned or you're going to get left behind.
Yeah.
So we're always trying to kind of stay ahead of the curve and just hear what other people are doing in other markets that are similar to ours. And flipping is always going to be around. The cool thing is because we have such an awesome opportunity to get in and get out, we can time the market accordingly and base our valuations off of that. On the bigger projects, that can be intimidating to some people if you don't have the know-how or just the team built up around that.
Right.
So that's kind of where we've looked at it from a different perspective of they don't want to do it, that I need to revisit that and see why they don't want to do it.
Right.
And if it's something that we have the ability to go and tackle, it's been, like I was telling you earlier, it's been pretty much our biggest margins and ROIs this year have come off of those kind of projects.
Yeah. So talk a little bit about how you identify an opportunity to add on, because you don't want to just go into any neighborhood and double the size of the square footage. I mean, you're going to have, there's no indication that people are willing to pay you for that. And of course, then ultimately you run into issues with appraisals and all that stuff if a lender is willing to do a house that is significantly larger than other houses. So
right.
Obviously there's ways to kind of identify where that will be accepted. So talk a little bit about that.
Yeah, I mean, we're not going to go into, most of these are older neighborhoods that have the opportunity to add on, whether that's, a larger lot size with a smaller house on it. And as older neighborhoods start to turn over, you'll see people in certain areas either tear houses down and build a new one, or start adding on over time. And the normal build and the time it was originated starts to get a little bit bigger due to just people living there and having expansion opportunities. We're not going to go into a neighborhood that is newer and try and add on when it's really not gonna make sense.
Right.
We're not going to go into a neighborhood that is a bunch of small houses and nobody's expanded into a larger house. I've seen a couple people make mistakes where they've gone into neighborhoods that have the opportunity on paper. It looks like it makes sense to add on, and the price per square foot is going to equal this. But one gentleman, he called me and was asking me for some advice, and he had built one of the largest lots in this neighborhood. He had built a house twice as big as any house in that neighborhood,
right.
The largest house. And when he went to go sell it, it was the nicest house in the neighborhood. It was by far the most expensive house in the neighborhood, and it just didn't fit the feel of the neighborhood. Right. So he overdeveloped. So you have to find those opportunities that allow you to create value that is still going to fit the charm and the criteria of the neighborhood that your end consumer is going to be looking for. Yeah. So we identify those neighborhoods. We identify potential houses that have unpermitted additions and weird kind of add-ons that may not necessarily even hold any value to an appraiser that we can repurpose or permit and get added on or redesign with the architect that's on our team. Or we'll go into houses that are completely dilapidated and take them down to one wall, do a full remodel, or we've done it this year where we've leveled houses.
Yeah. Yeah, I think it's important for people listening too to think about not just what somebody might be willing to pay for it, is that they're willing to pay for it and they can get it financed.
Right.
Because there's no the lenders are looking at it the same way. They don't really want to finance 97.5% or 96.5% of the largest house in the neighborhood that's selling for 50% more than everything else either. That's a risky venture.
That's a big red flag for them. Absolutely.
Yeah.
It's they're looking at risk versus reward, and if that looks like something that's non-conforming to the general consensus of the neighborhood, then you're not going to find too many people that are going to raise their hand and jump on that opportunity with you.
Yeah.
And that's the thing. A lot of people, I see a lot of investors make mistakes, and I'll be the first to raise my hand. I made a handful of mistakes starting out as well. Things can look great on paper, but there's a lot of intangible aspects to an exit strategy that you really have to take into consideration.
Absolutely, yeah.
And if you don't do that homework, you're gonna get. I always say you get caught with your pants down. You don't want to be that person, and especially when you're dealing with other people's money or your own money. That's where a lot of investors are one and done, and they think they look great. They go in, they make the mistake, and they're like, "Oh, this isn't for me." And it's unfortunate because I see so many people that have a lot of great potential and opportunity to make themselves some wealth through real estate investing, and they have one bad experience because they didn't do their homework and it turns out poor and they never go back.
Yeah. Yeah. I always encourage people, one of the things that is more common probably where we're at here versus Northern California is garage conversions. Personally, I don't like them. They tend to be pretty common on lower end houses here, but every once in a while, like we had a house that I ended up wholesaling last month that it was probably about a $400,000 ARV house, and it had converted the garage, and it really wasn't done that well. So you have to kind of look at. But what we were looking at is, the thing is that wasn't typical in that neighborhood to have a converted garage. So we're looking at things like adding another garage to offset that. And so, I always advise people, I have a very conservative nature in real estate investing, and it sounds like you do too, but I don't ever want to be a trend setter. Like I want to be a trend follower. And so I think whether you're looking at adding on square footage or converting garages or adding a second level or any of those things, you don't really ever want to be the first person to do that in the neighborhood, because you kind of want to do something that other people have done and proven that it works, and then it's a lot less risky that way.
Yeah, in my evaluations, from the sound of it, probably pretty similar to you, is I'm very, very aggressive in my negotiations for obviously always getting the lowest price where it's still a win-win for both sides, and make sure it's within integrity and doing it the right way. I'm very, very aggressive in how I bid my construction and rehab costs, and I'm very conservative in how I evaluate my after repair value and my exit strategy. So I'm always leaving myself along the way a couple safety lines.
That's right.
To make sure that if I'm evaluating off of 15% ROI and I still have these buffers in there, sometimes I end up at 19-20% because I was aggressive on all those fronts.
Yep.
Or sometimes I get caught with my pants down, but I only go down to a 12% because I left those buffers in there. So people that get a little too aggressive and don't necessarily take that stuff into consideration, like you said, being the trendsetter and really wanting to do it first. Mind you, there's a lot of people who make some good money off of taking that risk, but my model is more a longevity type model.
Absolutely.
I'm not looking for that one home run. I'm looking more for the long-term wealth built up over a sustained period of time.
Yeah, I agree with you. You can't build a sustainable business over planning for the best case scenario to happen every time, because it doesn't.
Right.
It doesn't, and especially in California, it doesn't. So.
Yeah, there's times where we've done completely different architectural designs and add-ons in, say, an $800,000 to $1 million house, and then there's smaller complete rebuilds that I've done on $100,000 house. Mm-hmm. And that criteria in the low end versus the luxury is you're appealing to two completely different buyer types, two different consumers, and if you don't take into consideration some of the different factors that are important to them, then that could also get you in trouble as well.
Absolutely, yeah. Hey, that's a great segue. Talk a little bit about what people should consider, what you look at in terms of the type of space you would add on, because there are generally some issues with adding on space. You don't want to have to walk through a bedroom to get to another bedroom, obviously. If you think of like adding on space to the back of a house, you usually have very few, if any. We've had houses before where we could have added on. There was just no natural way to add things on without going back and reconfiguring the main house as it is now. And of course, we see houses sometimes that have add-ons that they added on 400 or 500 square feet, but it was just this huge room that had really no functional or practical use that people aren't willing to pay for. If it was like 2 bedrooms and an additional bath, it'd be so much more valuable than just another big game room or something like that. But kind of talk through that.
Yeah, you see that a lot, actually. And I would say as a consumer myself, right, you walk into when I was working in my real estate business, and I was showing buyers and I was working with sellers, one of the biggest things that consumers look for when they walk into the house is immediately you walk in and you get a feel. And a lot of people really talk about at least when I saw, and when the feedback that I get is open layouts. The layout of the house is something that you can't change, and there'll be, oh man, you know what? That's just a weird space. What do you do over there?
Right.
Or, and kind of like what you were saying, some of the usability of certain areas in the home. So when we're going through a house, if there's an area that I can blow out an entire wall and create a massive great room concept, or if there is, we just did one in one of the luxury houses that I just put on the market. It was a downstairs that could have been used as, the way it was kind of laid out was a little funky, but it was easy enough for us to completely redesign that to be a downstairs master suite. And we made a few different configurations where you could walk into the bathroom. So it became this master suite, and that became a selling point because people wanted, in this luxury house, in this neighborhood, in-law quarters that was away from, say, the traditional master,
right,
and they didn't have to walk up the stairs. So just by simply taking into account, an old office that could be repurposed into a master suite by doing some wall changes and having a little bit of a design change, those are the kind of things where we look at the layouts and the spaces to make sure that the functionality and the usability and just the overall layout and feel of the house, if we can make it as open as possible and, make a house feel bigger than maybe what it really is.
Yeah.
Those are some of the smaller opportunities. And then there's also, unpermitted additions and add-ons that you don't really know what to do with. If we can, add 2 bedrooms and a Jack and Jill bathroom in there, and that bumps your ARV up, 40 or 50,000, and it only costs us 20,000 to do. Those are the kind of opportunities we're always looking for.
Yep, absolutely. So Matt, what advice would you give people that are? The first thing is you need to be in markets where your build price is, generally speaking, is a fair bit below your typical retail sales price, right?
Yeah, I would say so. You definitely need to look for those opportunities where I have a little bit of an edge. So not everybody's going to have this by owning a construction company, and
right.
I can keep my costs down on the construction side. I can also keep my costs down on the real estate side with listing our properties for free.
Right.
However, having an architect kind of on your team, I would say, has been the biggest game changer for us, because I walk into a house and things that my mind wasn't trained to see early on, he was catching, and he was going, oh, well, we can do this, this, and this. And just by having him walk through the houses and reconfiguring some plans for, a couple thousand, you're talking about adding, 20, 30, 40, depending on the house
Sure.
price point, 50 to 100,000 on some of these properties. And that's really important to have someone who understands how they can reconfigure some of these spaces. And then you also need to make sure that your real estate team can get you the idea of, if I were to do this and add, say, this bedroom and this amount of square footage and one more bathroom, how much is that going to get me? And then compare that to your construction costs, and you can kind of back in what your return is going to be on if you decide to do this.
Sure. That's great. Good advice. And can you kind of share, I know this is going to be, so let's say that you didn't own your own construction company, and build prices are dramatically different across the country. I'm sure that they're lower, for example, in Texas than they are in California. But
Sure.
Can you give some sort of guideline on what people should look at for? Obviously, you're not going to go into a neighborhood where houses are selling for $60 a foot, because no matter where you are in America, your build price is going to be below that.
Right.
But can you give some general guideline as to where the arbitrage opportunity, kind of a minimum that people should be looking for?
Yeah, we're looking kind of like what you said earlier. We're always looking for those neighborhoods that will get us our focus on your big rocks. So I'm like you said, I'm not going to go into a neighborhood that if I do this, it's only going to get me a $10,000 or $20,000 kick up by the price per square foot versus my build per square foot. So I'm going to go into the neighborhoods that are going to have higher selling price per square foot that will stay under what my construction costs are going to be. So I'm usually looking anywhere from 75 to 150 square foot price per square foot difference from my construction costs.
Okay.
So, and that's just me choosing what my criteria was, sticking to it, and saying if it doesn't fall into this bucket, I'm not going to focus my time or resources on that. I'm going to pass. I'm going to move on to the next one. And that was just a choice by me versus. So I know other people who, being on volume models and having the time and resources and the crews that are able to do it, they'll focus on, say, lower, opportunities, but they're hitting probably, 30 or 40 more homes than me. So it just depends on what the model is of the investor, and sticking to your criteria. It's easy to get pulled in so many different directions, and I feel like when you try and do too many things, that's where people get in trouble. Yeah.
Well, Matt, thanks for sharing all your insights today. If folks wanted to learn more about your companies and some of the work you're doing, where would they go?
You can always connect with me on Twitter at Matt Aitchison1 is my Twitter handle, or you can always contact me on Facebook, and it's facebook.com/Matty, M-A-T-T-Y, my last name Aitchison. And we're big on social media. My real estate partner and I actually teach on social media courses and how to integrate that into business. And
cool.
I find a lot of my deals actually through social media. So
that's awesome.
Always happy to connect with other people, and it's great learning from shows like yourself and all the great investors that you have on here. So it's been a pleasure chatting with you today.
Yeah, thanks for being on. We'll add links for some of the stuff you discussed down below the video. So if anybody wants to get a hold of you, we'll have links down below here. So Matt, thanks so much for your time today. Definitely appreciate it, and stay in touch, my friend.
Thanks, man. I appreciate it.
All right, we'll see you. Are you a member of FlipNerd.com, the most robust real estate investing platform in existence, where you can find off-market wholesale deals and great vendors literally in your market? You can get access to advice from experts and learn about local clubs and events right in your backyard. If not, please visit FlipNerd.com and register for a free account. You can register in less than a minute. It's pretty much the coolest site that's ever existed in the real estate investing industry, so get on over to FlipNerd.com.